stuff, and it's going to have to be relatively more distant. You know, actually, I'd hope to have Dynair code on this, as I said, but I don't. So this is going to be relatively more onto the. No, we've been doing economics already, so I don't know what I'm talking about. So here it is, and so let's start out with what the story is here. So if we kind of look at standard, I mean, what standard now is rapidly changing, but if we look at what was standard in 2007 models, the borrowers and lenders were all the same people in those models. And so the household, for example, was in charge of suppressing the household was the one who suppressed their consumption in order to do the investment. And they did the investment, they built the capital themselves, and they did the suppression of the consumption themselves, and that's how things work. Now the problem is, in reality, they don't work that way. In reality, the people who do the suppressing of consumption, they are generally old people with no real creative ideas anymore, but income. And the people who have the ideas for building investment goods are typically young people who have no money. So they're very different people, and they're not the kind of people that hang out in bars together. They're not exactly the same types. And as a consequence, there's trouble. And the reason there's trouble is this is borrowing and lending is essentially a zero-sum game. After we, if you're the borrower, after you built whatever it is that you're going to build with my money, then we have to take that pie and we have to cut it somehow. And what I get, you don't get, and what you get, I don't get. It's very much a zero-sum game. There's a conflict there between us, and that conflict. The conflict can occur. The conflict can be there for all kinds of reasons. There could be a moral hazard problem that you have an incentive to relax and go to the beach and relax or something, or you have an ability to steal. There can be steal stuff. There's all kinds of possibilities, and what financial friction models are all about is putting their fingers on exactly what it is, exactly the problem, and then what the models do is they generally come up with some kind of a framework, an institution or contract or something that allows people to deal with this problem that they have. And so what I'm going to do here, and we have many financial friction models, and there are many different types. What I'm going to describe to you here is what I think is the most successful model so far in macro, which is a model of asymmetric information and costly state verification. It is not the only model around. At the moment, I think it's the best model, and I hope that in the future it's not the best model anymore, because that means that we won't have been thinking very hard. This is going to be, I think, the center of attention in modeling in the next 10, 20 years, and so we should see a lot of action with this thing. So the model that I'm going to talk about was actually invented in 1978 by Rob Townsend, and also further developed by Gail Hellwig in the early 80s, so we're not talking about anything brand new here. The people who really pushed this model and brought it into attention is a classic paper by Bernanke, Gertler, and Gilchrist, who in a handbook chapter in 1999 showed how to kind of move it into a DSG type framework. Townsend was a very micro type of theory thing, whereas BGG, as we'll call them, they show how to bring it. And although the stuff that I'm going to be talking about is more the stuff that I did, which was to take, with my co-authors, which is to take the model and put various different types of shocks in it, and I'm going to show you how after you go to the data, you come away with a very different view. It might be an incorrect view, but you come away with a very different view about what's moving the variables around. In particular, you come away with a view that is driven by a fundamentally financial shock a risk shock. And this is data over the last 20 years. I'm not talking about the last, since 2008. In fact, this analysis was stopped in 2008, quarter 4. The data was stopped there. And what we found was that risk shocks, something called risk shocks, account for about 50% of fluctuations in U.S. GDP, which strikes me as ridiculously high. But in any event, it seems like an important shock. And what I'm going to do is I'm going to tell you the story of that. I'm going to tell you the whole story about how it is that you stick in these financial frictions, and then some kind of uncertainty that's living, that emerges because of the nature of those financial frictions is going to turn out to look like it can explain a huge part of business cycles. So the way I want to proceed is I'm going to go in 2 steps. I think the best way to do this is to do microeconomics first and then macroeconomics. What I mean by that is I'm going to talk about the details of the borrowing and lending environment without worrying about the broader economy. I'm not going to worry about capital accumulation, employment, how are interest rates. I'm going to just worry about the microeconomics of this contract. And then after that, I'm going to move it into a DSGE model, and I'm going to then explain to you what we found out about the risk shock. So this is the microeconomics of this thing. I'm going to imagine that there's a bunch of people out there called entrepreneurs. What entrepreneurs do is, or what's special about them, is that they have access to a particular production technology that normal people don't have access to. These entrepreneurs have their own resources, so they have an ability to invest in these projects all by themselves, but since they're the only people who are good at this, and because there are other people around who have resources but don't know how to invest in these technologies, there is a reason why the entrepreneurs should borrow. You know, if you're an entrepreneur and I'm another person who doesn't have access to the technology, I want to participate in your, you know how to make an iPad, really cool thing. I want to participate in that. And so I would like to give you money, and you actually don't mind borrowing the money. You'll see in a second, you won't mind borrowing the money at all. So we have a basis here for some lending. These entrepreneurs have their own assets, but it makes sense and it will happen for them to borrow. Now, N is the level of the entrepreneur's resources. By the way, at this moment, we can think of that as coconuts or whatever your favorite thing is. I don't know if there's no money. Maybe there is money. This is N units of resources is all it is. When we get to the model, of general equilibrium model, of course, you have to say what exactly these things is. But anyway, there's many entrepreneurs, and they all have different levels of resources, different N. There's a whole distribution of entrepreneurs by N. And what I'm going to be looking at is all the entrepreneurs with a particular level of N. You see what I mean? It's like a two-dimensional thing. You can think about in the vertical distance you have N. On the horizontal distance, you have on the vertical. So what am I saying? On the horizontal thing you have N, different values of N. High N's over there, low N's over there. On the vertical distance you have entrepreneurs. And so the world is a two-dimensional place where for every N there's a whole distribution of entrepreneurs. This level of N there's a distribution of entrepreneurs and so on. So I'm going to look now at the situation of one type of entrepreneur. This room here is going to be a special room where entrepreneurs of type N come. We will have other rooms where entrepreneurs with a different level of N go and borrow. We're talking here about N equal to 10,000. You guys come in, you're the entrepreneurs that are coming here to borrow. We are going to suppose a completely competitive environment. Everything is competition. If you're Canadian, you won't like this because you have like 4 banks in Canada. And in the US, maybe it's not so attractive either, but we have more banks, but in fact, we only have like 5 big banks, and then we have a zillion tiny banks. Anyway, we're going to suppose that the borrowing and lending is done in completely competitive markets, so that there's actually a continuum of you guys. I'm going to be the banker, but I'm a representative banker. There's a continuum of me-type people as well. We're all competitive. So everybody is atomistic in this world. And what we're going to talk about is, we're in the room here for N-type people. We're going to talk about the kind of arrangements that we're going to come up with. Now, I haven't described the environment to you, and I haven't even described what the problem is, other than that we have a conflict of interest, but I haven't shown you the details of that yet. Okay, so we'll talk about this, and then of course after we're done worrying about what kind of contract comes out in this room, then we'll talk about what happens in all the other rooms for different levels of N. Okay, so what is the project that the entrepreneurs have access to? Well, they have a project that has a rate of return equal to 1 plus RK times omega, where omega is a random variable that you individually draw, independently what everybody else is drawing. 1 plus RK, everybody is 1 plus RK, and omega is an idiosyncratic shock that you individually draw. The value, the mean of the idiosyncratic shock across all of you is 1. So the average return that all of you guys are going to get is 1 plus RK, but individually we don't know what you're going to get. Some of you are going to get high return, some of you get a small return. Actually, we're going to suppose a log normal distribution. So there's going to be some people like Bill Gates here who draw an incredibly high omega, but then most people are going to be, you know, in the log normal type of thing at the beginning. By the way, the shock that I'm going to have in here that's driving the economy is the cross-sectional dispersion of omegas. So sometimes, if there was no dispersion, then you're all drawing omega equal to 1. If there's no dispersion at all, you're all drawing an omega equal to 1, and you all look the same to me. If there is dispersion, then the average is 1, but there's a huge difference between what you guys are going to, what you each individually are going to draw. Some people like to think of late 2008 as being a time like that. Normally, when a bank approaches people, they're worried, you know, what kind of a person am I dealing with here? But in 2008, the degree of uncertainty went up because no one knew what happened as a consequence of the housing market collapse. No one knew what happened to the net worth of the individual borrowers. So different people became threatened to become more different, or there was more risk among people. In any event, in the model, there's this omega thing. Well, yeah. Here's kind of a picture from a helicopter of what's going on here. On the one hand, we're going to have households who are the source, normal households, who are going to be the source of lending. They're going to give their money to banks. The entrepreneurs are the ones who have these ideas. They have their own resources, and they're going to want to get money out of these banks. Now I haven't described the problem yet. Here's the problem. Or before I describe the problem, let me describe you what normally would happen in an economic model, is each of these guys are going to have an uncertain return. So the normal thing to do would be give each one $100 and then just give me a fraction of what you get. That's called a sharing contract. You have a sharing contract. I'll give you $100, and then whatever you get out of this thing, give me you keep a fraction because of, you know, you're a cool person, and give me the rest, and that's the way you're going to do it. That contract is not feasible in this environment because only the entrepreneur actually sees omega. Only the entrepreneur sees what actually happened inside this contract. Ex ante, the entrepreneurs don't know what kind of omega they're going to draw. So ex ante, the entrepreneur is all excited. They're going to build an iPad, or they're going to build something, and they're hoping it's going to be an iPad, but it could turn out to be something else. And ex ante, no one knows, but ex post, all kinds of stuff happens. And some entrepreneurs draw a high omega, some draw a low omega, and the banker doesn't know. In particular, whoops, oh, I thought this was a pointer. In particular, the entrepreneurs have an incentive to underreport what they got. Relative to the sharing contract, the entrepreneur would say, look, I'm sorry, it didn't work out. Let's try again next time, and I'm sure it'll work then. So and the bank would, of course, hear that from everyone. Now, the bank knows that if everyone says that, they're lying. But in any individual person, they don't know, they can't tell that any individual person is lying. You know what I mean? So I remember when I was a kid in high school, what we would do is, it was Mr. McCrary, who was the math teacher. And Mr. McCrary was a very sad person, and I'll explain to you in a moment that he was actually fully justified in being so sad. So every time he turned around to write some math stuff, somebody would take one of those, like a straw that you drink your Coca-Cola with. And you get a paper thing, and then you wet it with your tongue, you make it into a nice, big, thick thing. You stick it at the end of the straw and go, And then the thing would hit Mr. McCrary, and he would turn around. Okay, everybody had the most innocent look on their face. So he understood that someone had shot the spitball at him. But any individual person he talked to, of course, he couldn't prove that, they would all deny it, and of course there was no way to prove. And it's the same way here. All these people would deny having any return, but the bank literally cannot go in and tell them, can't go in and, because it's true that there's some chance that they would get a low return. There's some fraction that are getting a low return, they don't know which ones are which. Now, it will be assumed that the bank can see it, what they did, but only at a cost. So we can go through bankruptcy proceedings. The bank could, through great expense, see what the individual person does, but that's not very efficient. If we had a sharing contract, the bank would have to declare bankruptcy on everyone and would have to investigate everyone, and that's assumed to be a cost that's too great and would be inefficient. It would make intermediation impossible. I mean, we see that now. We see bankruptcies, a lot of bankruptcies going on now in the United States, and you see how expensive and costly bankruptcies are in terms of lawyers, in terms of the banks trying to get assets. So the sharing contract will not be feasible in this environment because it's simply too costly. You would have to go and monitor. Look, the word monitor is used here. You'd have to go and monitor every individual entrepreneur, and that would be too expensive. So what you get instead is what Rob Townsend called the standard debt contract. He must have been astounded when he discovered this, because the standard debt contract is what it says. It's like a normal contract. The standard debt contract says, I'm going to lend you $100, and here's an interest rate, 10% or something. And if you pay me that 10%, we're done. You can just leave, we're done, no problem. I know that some of you will not be able to pay that 10% because some of you, this is a log normal distribution, some of you are going to draw an omega that's too low. You won't be able to pay back, so you're just going to have to raise your hand and say, because you don't have the money, you're going to have to say, I can't pay you. And I will then go and monitor you. Now, if we structure this contract okay, then I will only be monitoring a very small fraction of people, and everyone else will just pay me the interest and go away. Now, that's not I regret having a conference like a contract like that as a bank, because I know some of you are Bill Gates, are going to be Bill Gates, and my standard debt contract is not going to share in your tremendous gains. On the other hand, the standard debt contract does have the property that I'm not going to have to do a lot of monitoring. In fact, when you kind of calibrate these types of models, you rig them so that you get about the bankruptcy rates that you observe in the data, and bankruptcy rates are really quite low. Okay, so this is the standard debt contract, and all right. So the entrepreneur is going to receive a contract from a bank, and the contract is going to give an interest rate Z. This Z here is the name, this is the work of genius of the Bernanke, Gertler, and Gilchrist. They decided to call this Z. I mean, who would ever think of calling an interest rate Z? I don't know, but that's what they did. They did the Z. So everybody has to follow them because of that. So the contract has two numbers, a Z and it has a loan amount. And if the entrepreneur can't pay it, then the bank pays the bank has to pay a monitoring cost, and they take everything from the entrepreneur. Okay, so here's some notation. The net worth of the entrepreneur is N, which is, by the way, a fixed number in this room because we're fixing N. And the amount of the loan you get is B, and therefore the assets that you're going to acquire is A. The entrepreneur gets assets A. And the entrepreneur has to get a sufficiently good omega in order to be able to pay the debt back. There's an omega bar, which is going to be the critical cutoff. For all omegas bigger than omega bar, they can pay back the interest. For omegas, the unlucky ones who get an omega less than omega bar, they will not. There will be this critical cutoff, which actually plays a big role in the analysis here. So what I want to do now is I want to move towards the development of an equilibrium contract. So this is a contract that's going to evolve between us, and we're totally competitive. To do that, I'm going to have to figure out your preferences, and that's what I'm about to do now. I'm going to make some kind of goofy assumptions about your preferences in the process. And then I'm going to have to represent my situation as a banker in the right way, and then we're going to combine those things and you'll see the equilibrium contract. Okay, so this is going to be the utility of the entrepreneurs. I have in mind here that the entrepreneurs want to, their utility is the end of period resources that they have. So for omegas that are less than omega, so this is the ex ante expected utility of the entrepreneur. Ex ante, they form an expectation based on the log normal distribution. Ex ante, they think they can get an omega going from 0 to plus infinity. They know that ex ante, however, they will only gain anything if omega is higher than omega bar. That's why the integral starts at omega bar, not below omega bar. And then what they get, if they get anything, they get 1 plus rk, which times omega times a. That's the total return that they get. These are their assets. And this is the return on their assets, so this is what they get, this is what they pay. Omega bar is defined as the point where this thing here is 0. Omega is less than this, it's negative, or actually they get cleaned out, so they just get 0 at that point. And here I divided this by what are state variables in this system here. So n is just the net worth of the entrepreneurs, but we're looking at a room full of particular n, so this is just a number. And r is the cost of funds. R is the deposit rate at banks, and that's totally exogenous in this room here. This is something that's determined in the broader economy. So I'm just dividing by these scalars, actually for convenience. So let's work out what these entrepreneurs' utility, so to speak, looks like. So what I did here was I took, this is the utility function that we got from the previous thing, and then what we did was I'm subtracting something in terms of the omega bar. So omega bar is defined as the value of omega that makes this equal to that. Because that's when they exactly, their revenues equal their cost. So I can do this substitution. And then because of this substitution, there's a cancellation here. I don't know why. There we go. What is it? This thing is like sleeping. I have to push it. There. Okay, so it comes out, and the there's a new little thing that came out there. So there's a little thing called L there. So L is equal to is leverage, and leverage is A divided by N, or it's equal to B plus N over N. You can write this in 5 million different ways. B over N plus 1. Because I divided that thing by N, and because you got assets there in the numerator, what pops out when you take the ratio is leverage. So it turns out to be convenient to write this in terms of leverage and no loss of generality, because I'm dividing by net worth, and the net worth is just a state variable from the point of view of our discussion here. And you can see also, maybe it's not so obvious, but the omega bar can be written in that form, because so we have that z times b is equal to 1 plus rk times omega bar times a. That's the definition. The definition of omega bar is the value of omega that makes the revenues equal to the cost. So any lower omega and you're bankrupt, any higher omega and you're fine. You're making positive profits. So this omega bar here is equal to z over 1 plus rk times b over a, and then b over a is b over b plus n, and that's equal to 1 over b plus n over b, and that's equal to 1 over 1 plus n over b. Actually, I think I'm going in the wrong direction here. Sorry, wait, how do I want to do this? Shoot. So what I want there is, I want b over a. Okay, b over a equals b over n times n over a. Sorry, this might be a disaster. I think I'm participating in a disaster now. B over n divided by L. Is that okay? Okay, now what about b over n? So is b over n equal to L minus 1? is it equal to B, L minus 1 is equal to A over N minus 1, which is equal to B over N. Because A is equal to N plus B, so N plus B divided by N is 1. You see? See how simple it is? The problem is that formula is very important. So you have to be persuaded that it's correct. And it's very important for the following reason. If you look at the utility of this entrepreneur, notice that L kind of shows up in two places. It shows up here, and it shows up here because of the omega bar. And the thing to notice is that as L gets bigger and bigger and bigger, their utility is always getting bigger from the point of view of that place where it shows up. Holding omega bar fixed, as L gets bigger, this is constantly getting bigger. On the other hand, as L gets bigger, omega bar, you can see here, as L gets bigger, this is 1 minus 1 over L. As L gets bigger, this is this getting smaller. This omega bar here is getting bigger. And as omega bar gets bigger, this whole thing here gets smaller. It's like L has two effects here. One is that it makes things bigger. The other thing is makes things smaller. Why does it make things smaller? Well, because the more the L is just related to borrowing. N is a fixed number. So the bigger is L, the more they borrow. The problem with that is by borrowing more, you have to have more luck to break even. So that's a source of negative utility. The more I borrow, it's more likely that I'm going to be bankrupt, and so I won't be getting anything out of this deal. This is a bad thing. On the other hand, the more I borrow, the more I get in the beautiful state in which I'm not bankrupt. That's where the L outside over there is. And these two effects, one is weak and one is strong. The one on the right there is very strong. It just has a constant power. But omega bar, notice that as L gets larger and larger, omega bar stops changing. That's 1 minus 1 over L. As L gets large, that's just 1. So as L gets large, it's just like I don't have any net worth at all. And I still need a certain amount of luck in order to break even, but after I have no net worth, it doesn't matter. But I'm still making money when I'm Bill Gates. In particular, in this environment, utility is unbounded above in L. If I ask you, the interest rate is 10%, how much would you like to borrow? You would say, infinity, please. And that's independent of the interest rate. If I tell you Z is 10 billion, I said, yesterday it was 10%. We had a good day yesterday. But today it's 1,000,000% you have to borrow. You would say, I'll take an infinite amount there too. This utility function is always increasing. Basically because they're kind of bounded on the left side, on the low side, and they're unbounded on the right side. They can always have a crack at being Bill Gates. And in the event that they were Bill Gates, they do become Bill Gates, they would wish that L was infinitely large because their profits are linearly increasing in that. So utility is unbounded in borrowing. In particular, we can't do a standard Marshallian cross demand and supply for loans here. We cannot come up with a demand curve for you guys. Normally you have demand is downward sloping and supply is upward sloping. We can't do an environment like that because if I give you an interest rate, you can't give me a loan demand because you always have an infinite amount of demand. So we cannot use the Marshallian cross concept of equilibrium in this type of an environment. And by the way, this is pretty standard. In financial friction environments, the Marshallian cross type of thing, like the thing that works so well for the market for apples, for oranges, and stuff like that, just don't work here. And you have to do something else. We're going to deal in something called the market for contracts. So, anyway, this is what I've just been saying here. And here's the problem. For any interest rate, they always have an unbounded utility function. But of course, in equilibrium, you can't have unbounded borrowing. So it's just not a concept that's going to work, the Marshallian cross stuff. And so what we're going to be dealing with is in equilibrium contracts. We're going to have demand and supply for the whole damn contract, not just for B, but for a Z and a B. We're going to offer people contracts are going to be traded in equilibrium, not whatever it is in this Marshallian cross thing. Now, there's a very natural way of thinking about a contract in this environment, but you have to twist your head just a tiny bit to do that. If you look at this utility function here, in the end, it's best expressed in terms of omega bar and L rather than the more natural Z and L. There's not a big difference there. I mean, for any given L, omega maps directly. If I tell you what L is, RK is just a known number. If I tell you what L is and I tell you what omega bar is, you can back out what the interest rate is. If I tell you how much luck it takes for you to break even, you know implicitly there's an interest rate in there. So we can equivalently characterize the contracts as involving omega bar and L as opposed to involving Z and L. Z and L, of course, the natural thing, and you're probably already irritated at the whole concept of going into this peculiar omega bar L space. It turns out it's slightly more convenient to think about contracts in terms of omega bar and L. So that's what we're going to do. We're going to imagine the contract in terms of omega bar and L. And I'm going to characterize the preferences of the borrowers in terms of their indifference curves. So the indifference, omega bar is roughly the interest rate. That is, higher omega bar, bad. Higher luck that you need to be able to pay back, that's something that entrepreneurs don't like. And more leverage, they like that. So utility is increasing from the point of view of the borrowers in the direction of that arrow. You can't possibly miss that little arrow over there. And the indifference curves are positively sloped, meaning that if I give you more leverage because you don't like high omega bar, to get back to the same utility level, as you get more leverage, you have to get a higher omega bar. That's the. If you get confused and you start thinking about that omega bar as Z, you actually don't make a mistake. It's not a thing. Okay. Now the banks. I have to describe both sides of the market here. So the banks borrow from the households at the interest rate that they borrow is at R. That's what my source of funds is R. I'm small relative to that. I'm small relative to you guys. I'm also small relative to the source of my fund. So R is some fixed thing that's fixed up in the sky somewhere. And I'm going to borrow B units of currency per entrepreneur that I'm dealing with. And then I'm going to lend that to the entrepreneurs. And I'm going to give the entrepreneurs a standard debt contract. I haven't told you about the monitoring. I've said it verbally, but I didn't describe them to you. The monitoring costs are going to be that. If you declare bankruptcy because you have an omega less than omega bar, then the bank is going to have to buy that many goods in order to go and observe you. They're going to have to pay a fraction of the amount of resources that you have. I mean, one way to think about this is suppose that General Motors declared bankruptcy. Well, General Motors is a company that spans the whole globe, and to figure out what are their resources, in fact, you're going to have to send armies and armies of lawyers and stuff like that to go after them. If, on the other hand, you have a peanut vendor on the side, downstairs over there, who has a little cart and is walking along the river and declares bankruptcy, well, you can just send some, it's not a big deal to go in there and investigate. And what's the difference? The difference is the assets to be investigated. So we're supposing here that the monitoring costs are proportional to the assets that the firm has. Okay, now the bank, because I'm going to suppose perfect entry into banking, the banks have a zero profit condition. They have a zero profit condition because, well, there's no uncertainty in banking. I don't know if you're going to pay me back. I don't know individually, but I also don't even could really care less. What matters to me is how many of you will not pay me back and how many of you will pay me back, and that is perfectly deterministic. There's no uncertainty about that. So my revenues as a bank are totally deterministic because I'm imagining that I'm perfectly diversified as a bank. So my revenues are the fraction of the entrepreneurs who are getting an omega bigger than omega bar, so that's 1 minus the CDF of omega bar, times the amount that they pay, plus, and then this is what I get from the bankrupt people. If you forget this mu for a second, you can see these are the resources of the bankrupt people that I'm grabbing. I'm adding over all of their resources, but then I'm subtracting this mu because of this assumption up here to describe what I actually get. So these are the revenues that the bank gets when it issues a standard debt contract with parameters Z and B. And now, the amount that they owe to the households is just this, 1 plus R times B. R is a given number, and the bank has to make the left equal the right. If the left was bigger than the right, there would be profits in banking, and you would have entry. If the left was less than the right, then you would have losses in banking, and there would be exit. The only thing compatible with equilibrium is the left is equal to the right here. We don't have time to talk about this, but some people have noticed that, oh, you know, these banks, they look like they don't go bankrupt, and so that's a bad thing. There's some very nice papers, actually it came out of the Bank of Japan. 3 economists at the Bank of Japan wrote some nice papers to show how to kind of redo this type of environment so that you actually had risky banks as well. But in this setup here, you don't have risky banks. Banking is not risky. Although you could interpret these entrepreneurs as banks, but anyway. Okay, so let's get the situation of the banks cooking here. So here's the zero profit condition. Now I'm going to substitute out ZB and get this thing over here. And the next thing I'm going to do is divide by, see there's a common thing here, 1 plus RK times A. Divide through by that thing, and here you've got that, and then you get things in terms of leverage. So I now have the bank. What banking kind of means is zero profits. That's the only thing it means here. And that zero profits imposes a relationship on omega bar and L. That's why it's very convenient to talk in terms of omega bar and Z and L as opposed to Z and L, because both the preferences and the situation of the banks are naturally expressed in terms of omega bar and L. I can graph this little diagram here, this function here. You can see here that if you do the graph, what you'd like to do is you want to fix omega bar and then compute what the left-hand side is and then compute L, because there's a unique mapping from omega bar to L. You don't want to go from here to there because that's like a nightmare. You want to go the other way around. And so this is the way the graph was done. On the vertical axis, there was a bunch of omega bars computed. For each omega bar, I computed the L that was associated, then I rotated the diagram in MATLAB, and so I got that leverage on the horizontal axis and the omega bar on the vertical axis. And the key thing to notice is that, well, first of all, that equation is only consistent with leverage over a certain region, and then there's also a backward bending component there. For these high levels of leverage, there are 2 levels of omega bar, therefore 2 interest rates, that are compatible with zero profits. But the higher one is of no interest because the entrepreneurs they would never choose a contract up there. So you can think about this curve here. You can think about this curve as a menu of contracts. So now let me actually define the market environment that I'm going to imagine here. I'm going to suppose that the market works like this. The banks put on their windows a picture of that curve. And people are told, that's a menu, and people are told you can pick any contract you want off of that menu. And then the entrepreneurs come along, and they're going to pick a contract, and guess how they're going to pick it? They're going to pick the one that generates the highest utility for them. Well, we have their utility map, looks like, it's these lines that look like this. And they're going to go to the furthest point they possibly can over here to where they get a tangency. And that is the equilibrium. So the equilibrium concept is that you have a menu. It's like you guys walk into this room and you get this beautiful menu. And the menu specifies, okay, you want high leverage? Fine. You have to pay a slightly higher interest rate. Or you want low leverage? Fine. Then you pay a slightly lower interest rate. Why does high leverage require high interest rate? Well, banks are very pessimistic. They're not thinking about the Bill Gates. They're thinking about the problem when you go bankrupt. And the more leverage, the more you borrowed when you went bankrupt, the more the monitoring costs are. So you can certainly borrow more money from a bank, but the bank also realizes you're going to be a pain in the butt if you go bankrupt, and some fraction of you will, and they're going to charge you for that. So that's why we have this menu that's positively sloped. Again, this is all perfect competition here. No bank has any incentive to put up any different menu, and then the, okay. Now, mathematically, well, I suppose we do need to, this is all, in this literature is a pretty kind of standard notation. I mean, I look at this stuff and it's like the ISLM model to me in terms of familiarity. But I've got some notation here. For example, this object here is of substantial interest. This is the expected value of omega that you're going to get out of people who go bankrupt. This is the expected value of omega, or it's the average of, it's not the expected value, makes it sound like a conditional expectation, not the conditional expectation, but it's the sum of the omegas for the bankrupt people. If you divided it by the probability of bankruptcy, then that would be a conditional expectation. So G of omega is all the omega, it's the sum of the omegas coming from the bankrupt people. This is a sum here, and this is the number for each omega. And this gamma here is omega bar, it's this thing here, and this gamma is the resources that the bank gets out of entrepreneurs. Remember, if we go over here, we looked at this thing, notice that, we do all this substitution, and then you see at the very end, you get 1 minus f omega bar, blah, blah, blah. This is the amount of, this is the fraction. See, just pull out that 1 plus rk times a. That's all we did there was from there, that line to that line, you just pull out the 1 plus rk times a, and the thing on the left was what the banks get. So what that thing is over there is the fraction of what you guys are getting that goes to the bank. Can you see that? Can you feel it? I wish I had an additional line there where I just pulled out. The line above is the same as that line, except that one has 1 plus rk times a multiplying that. 1 plus rk times k is the average of what all of you guys are going to get, because what you individually are going to get is going to get that times omega, but the average of omega is 1. So 1 plus rk times k is the average of what you guys get, and what the bank gets to keep is gamma times that. So gamma is the name for the share. It's like a pie. You guys are making a pie. It's 1 plus rk times a. You're all getting the same loan amount because you're all the same. You have the same preferences, so you'll pick the same contract. And the bank is going to get gamma of that, and of course you're going to get to keep 1 minus gamma of that. Anyway, that's just notation there. And then we, I don't know, it's nice to know what this derivative is here. The derivative of gamma with respect to omega bar is, if you do Leibniz rule and a bunch of other stuff, you get it's 1 minus f, which is positive. Not surprising. When the interest rate goes up, the bank gets a bigger share of what you guys produce. Okay, let's actually compute the damn thing. We have to compute this thing because this is also a computational course, and I want to show you exactly how you get this contract into a model. So, so here are the preferences of the, we already derived these preferences, the utility of the entrepreneur before. Just playing around with this, and you can see very quickly that given the definitions of stuff, this is equal to that, or this is 1 minus gamma times that. Of course, it can be nothing other than this, because gamma is going to the bank, 1 minus gamma has to go to the entrepreneur, so if this somehow didn't come out to be a 1 minus gamma, there'd be something wrong here. But in any event, there we go. This is the utility function of the entrepreneur can be written as this 1 minus gamma, the share that they get from the profits, times this thing here. Remember, I divided by n times 1 plus r before. That's what's causing this to be leveraged, and that's what 1 plus r is doing over here. See, otherwise this would be an a, and this guy wouldn't be here, so what they're getting is 1 minus gamma times their average returns. Okay, so let's move closer here. So what I'm doing now is I'm rewriting this expression here to give me this term here in terms of L. I just take this zero profit condition and write it in terms of gamma minus mu g. This is the share of what the entrepreneurs make that the bank gets, but then the bank has to pay the monitoring costs, so the bank actually gets gamma minus mu times g. then solve this thing for L, and there we have the bank zero profit condition. So then we go to the next step, and we talk about maximizing what will the entrepreneur select as the contract. Well, what their utility function is, it's this times L. But L has to be equal to, has to be taken off the menu, so it's actually this times this. So now the problem of the entrepreneur is a one-dimensional problem. They just have to pick an omega bar. Because it has to be on the contract, they can just pick something off the vertical line. The menu gives them the location on the horizontal line. So you just take this thing. I don't know, I like to log things before I maximize whatever. The first order condition associated with that problem is that thing there. That's a very important equation. And a model that includes this kind of stuff, that equation there characterizes omega bar. It characterizes the omega bar in the system. It's one equation, and that's the only unknown. Remember, the 1 plus rk and the 1 plus r, those are determined elsewhere, or in a DSGE model, in a general equilibrium model, those will be determined by other relations. So you can think of that equation as one equation and one unknown. Then you can take that omega bar that's coming out of that equation, you can compute the implied equilibrium leverage by going to the menu, and then you can back out what the interest rate is on this contract by just using that thing there. And you could even talk about something you might call the risk spread, which is a fun variable. The difference between Z, which is the interest rate at which entrepreneurs borrow, and R, which is the risk-free interest rate at which the bank borrows. That spread in this model is due entirely to the probability of bankruptcy and the costs of bankruptcy. In fact, when we talk about financial friction models, to some extent you can define a financial friction model as the answer to a particular question. Why is there an interest rate spread? Why do people have to borrow at higher interest rates than other people who are the source of funds lend at? And the answer that this model comes up with for the interest, why there is an interest rate spread, is because there are actual bankruptcy costs out there. There are other theories like liquidity theories of interest, risk aversion theories of interest, various spreads, or all kinds of other theories. This one focuses entirely on the costs of making loans that arise from bankruptcy. Okay, there's actually an important result on this page, because if you look in here, we've now calculated the equilibrium contract. We did it for a particular value of n, but notice that now in our calculation, there is no n. We are able to compute omega bar, we're able to compute L, we're able to compute Z without reference to n. That information about the value of n of you people in this room has been lost. It doesn't appear anywhere in there. So in particular, I know that if I go to another room with a different n, the equilibrium contract will satisfy the exact same equations. This theory is telling us that leverage and omega bar, and therefore the interest rate, are independent of borrower net worth. And that's sort of summarized in the next page over here. Of course, that doesn't mean that borrowing is independent of your net worth, because if your leverage is independent of your net worth, then the implied borrowing, of course, is that borrowing is now proportional to your net worth. So people with low net worth will not borrow a lot. People with high net worth will borrow a lot. So there's this thing, and the interest rate is not a function of net worth, and so on. No. Why? Because. Because why? Well, I'm assuming that all the entrepreneurs are dipping into the same F function. How many people think that everybody in the world dips into the same F function? No. If Steve Jobs goes in and he says, look, I put some plastic together, I put some wires together, I put a little bit of glass together, and I made something, you're going to think it's probably a pretty damn cool thing. That when he made that, he dipped into a pretty creative situation. If the person with a torn shirt and the goo coming off on the left side of their cheek put glass together and wires together and so on, you know that's not going to be a good sign. So in this environment here, I'm supposing that all you guys in this room are the same risk, have all the same risk characteristics. So I'm saying among the people with the same risk characteristics, everybody gets the same interest rate and the same leverage. If we made this situation a little bit more complicated, we imagine that there are people with different types of risk characteristics, then you would imagine that people would get different interest rates and so on according to their risk characteristics. Now, in the data, it's probably the case that people with low net worth pay higher interest. Well, it's also going to be the case that statistically, the people with a high net worth have better risk characteristics, right? Don't you think? Suppose you see somebody with a lot of net worth, and you know they got there by drawing from a well called F. Was that a good well they were pulling from? I'll give you a hint. Yes. So high net worth is going to be, it's probably statistically correlated with good risk characteristics. And I don't want to say, I'm sure there are people who are very evil people who have high net worth and they have very bad risk characteristics. No doubt about that. But I mean, just correlation-wise, it's probably the case that someone who has been in business for a long time and has a lot of net worth is probably typically dipping from a lower risk well, and those people would then get a lower interest rate. Not specifically because they have high net worth, but rather because they're interpreted as drawing from a low risk F distribution. Okay, there's one thing that there's an issue in terms of when you actually put this stuff into a computer, you have to actually type in those formulas. There's an issue about how do you type in things like F prime, where do you get that, where do you get these things from? And there's a discussion here, there's like a little cheat sheet here about how you do that kind of stuff. Now me, I love this. I could spend days talking about these wonderful formulas, but I'm going to deprive myself and yourselves of this pleasure now. You can just refer back to that. So you can see here, what you get out of this formula is just showing you if you want to evaluate G of omega bar, you know what omega bar is and you're trying to evaluate G. How can you do that in a computer? Well, all this shows you is that if you go to a CDF for a standard normal distribution and you plug in these exact parameters, then you get your G of omega bar. And this is the kind of thing you need to program in G of omega bar. So, and so the way you would do that is you would just use the CDF, which is standard in like MATLAB, or you have access to it in Dynair and stuff like that. And similarly with F prime, as you'd expect, the derivative of F with respect to omega bar, this should be omega bar here, it's going to involve the standard normal because, I don't know, that's what you would have guessed. But anyway, there's a proof of it here. Here is the key thing I want to show you in the macroeconomic. Well, partly I want to show you what the environment was, but then I want to show you a comparative static exercise that's going to be kind of important, which is what happens if the comparative static is going to be I want to compare the loan contract that's going to occur in equilibrium when risk increases. Okay, so I'm going to compare two situations: one where the differences between people is relatively small, and another one where the differences is relatively large, where the risk is larger. So I'm going to start, and equilibrium is characterized by a point of tangency between, on the one hand, the menu, which is the zero profit curve. Here's the menu of contracts that you get. And the indifference curves of the entrepreneurs, which I now have drawn in the space of spreads and leverage. And I'm only showing you a small snippet of the whole space because I'm not going all the way in both directions there. So I'm imagining that we're starting in an equilibrium where we're in a situation like this, and the risk spread is the difference between Z and R is 2.52% at an annual rate. I mean, it's not particularly important what the value is. And the equilibrium leverage here is 1.13. I'm just starting with this thing. And I want to ask the question, what happens if risk increases? So, well, that depends. The answer to that question is what happens to the indifference curves and what happens to the menu of contracts. So if we look at the menu of contracts, that's this, and that. Here's the other, see the two arrows here. This and that are the two contracts. So one of the things you can see is that when risk increases, the menu of contracts shifts up. Of course, that's exactly what you'd expect. When risk is higher, what it says is that for a given level of leverage, like for example this one here, you can get this particular loan again. But if you want that loan, you're going to have to pay a higher interest rate. Why? If you take out this loan, the same loan, and you pay the old interest rate, what's the problem with that? When there's more risk, when the distribution is spanned out more. The mean is always 1, so this is a mean preserving spread on the omegas. So the cross-sectional distribution of omegas is going to be spread out. Why can't the bank offer the exact same contract they were offering before? Well, because the distribution is more spread out, it means that there are more people on the left side. There are more people who are making low omegas. And those people are going to be there's more expenses in banking if there's more risk because there's more people going bankrupt. So the bank it can offer the same loan, no problem, but it has to charge a higher interest rate because it's going to end up, more people are going to tip over into a low omega when there's more spread in the omegas. Is that, see, I feel like I'm saying something that may not be so clear. Okay, the distribution of omegas is something, and I'm spreading that distribution out. So the bank cares, of course, the left side, the low side of the omegas, and there's more people out there on the low side in that case. So anyway, the contract is, the menu contract shifts up. Now then, the indifference map also shifts in ways that are hard to describe or have any intuition about. The indifference map is still the same shape, but it also twists around a little bit in some obscure ways when the risk goes up. And you can see the new point of tangency is over here, and in this model, with all the various features of this environment, has the property that when there's an increase in risk, what happens is that the risk spread goes up, boom to boom, and the amount of leverage goes down. In theory, it's not necessary that this would, in theory, you could end up over here. The equilibrium could go up over there, depending on how all these curves shift around. But with this environment, what happens when there's an increase in risk, what happens is the banks, in effect, have to charge high interest, and entrepreneurs end up taking out fewer loans. That's the thing. By the way, you can now see how risk might create a business cycle. If you imagine this thing being in a big system, you have more risk. The banks have to charge an increased spread. The entrepreneurs respond by borrowing less. Now that per se is not such a big deal. But then when they borrow less, they have fewer resources, so they buy less stuff. Now we have a demand situation, and we can have output going down and employment going down, and we could have this thing creating a recession. Now you actually have to load it into a big model to actually see if that happens, so that's what I'm going to do now. So I'm done with the microeconomics of this thing now. Now we're going to take this thing and put it into a thing. Now, this is going to have to be a very carefully executed surgical incision here. You cannot put these frictions in any old place. You have to put it in exactly the right place or it ain't going to work. The reason why the BGG model works well is they put it in exactly the right place. Other people, like Karlstrom and Fierst, actually developed a model just like this. If they put it in slightly the wrong place, and it has exactly the wrong and terrible macroeconomic implications. So where you put things makes is going to make a big difference here. It makes a big difference. All right. So the way I'm going to describe this is I'm going to start out by describing the standard model, and then I'm going to talk about how to modify the standard model. I'm taking some kind of an intuitive approach to this. Some of you may hate this. You may prefer just to see the equations and want to hear the bullshit, and some people maybe like who knows. Unfortunately, I'm only ready to do the intuitive thing. So here's the standard model. You have the households on one end, you have the firms on the other end. The households in the standard model, not the one with the BGG stuff in it, the standard model, they are the source of all factors of production. So they have labor, they have capital, they then rent those things to the firms, and the firms then produce stuff using that production function. By the way, I'll also show you, because I'm going to go to the data, we're not going to talk about that too much, but I'm going to have a whole bunch of shocks floating around, so I might as well tell you what all these shocks. So I got a shock here I'm going to have a shock here in the production function. This turns out to be a Phillips curve shock. This moves prices around. This is a markup shock here. I'm going to have two technology shocks. This technology shock here is a unit root shock, and this shock here is a stationary shock. By the way, I remember once telling somebody, there's a shock here and a shock there, and then they said, well, there's no way you're going to tell the difference. You got two technology shocks. How can you possibly tell the difference? And do you think you could tell the difference econometrically between these two shocks? Unit root, stationary? Yeah, we spent an hour on that this morning. This model behaves very differently in response to a disturbance here, which launches a big demand effect, and a disturbance here, which has a weak demand effect associated with it, because this is a stationary shock. So these are actually econometrically distinguishable shocks. Anyway, there's a couple shocks, 3 of them for you. So they rent them out, then those guys produce stuff, and then, of course, not surprisingly, all the goods then get sent back to the households. The households eat some of them, and the other part of them are investment goods, and the household in its backyard is busy building new capital. And its capital accumulation decision is made according to this equation here. And then they have some kind of an adjustment cost function. This is the production function for making new capital, which has itself a shock in it. It's called the marginal efficiency of investment. See, that's the marginal efficiency of investment shock. This is a shock that previous to this, I would say currently the belief is that this is the most important shock. Based on model estimation and stuff like that, this thing here comes out to be the most important shock. And this shock will be removed from its throne and will be banished in what we're going to be doing in the next few minutes. The marginal efficiency of investment shock is typically in standard models comes out to be about 50% of GDP in terms of importance. This is like the big shock. It's a technology shock in the production of investment goods. And the households in the standard model, they have this standard Euler equation here, the first order, beta, marginal utility, rate of return on capital, and all this stuff governs the investment and capital accumulation decision is wrapped up with that equation, and then also with this first order condition here. Okay, so kind of a bird's eye view of this standard model is that households are the source of labor. The labor goes to a labor market. The laborers go to the firms. The households have capital. They send the physical capital to a market for physical capital, and then that gets rented onto the firms. Then at the end of the day, consumption pours down back to the household and investment, and then the next period we continue, and that's the standard model without the even that standard model already has a financial friction because you often have working capital that the firms have to borrow in order to pay for things. So you already have some kind of a financing friction in those model. But we are going to add the BGG stuff here, and that's going to change life as we know it. When you put that stuff in there, you change very much the picture of what is the set of important shocks. Now I have to explain exactly how this gets done, and I want to repeat that it's very important exactly how you do it. If I'm able to get through the rest of this, and I think I might be able to, I will show you the simple intuition about why it's so important exactly where you stick these financial frictions. Okay, so in the standard model, the households have the capital and they rent it into the market. And that's a completely homogeneous, plain vanilla thing. No one ever talks about what does that mean or anything like that. What the BGG story is going to be that actually putting capital into the market is some special thing. There's some kind of special creativity that only certain people can do. It's a big deal. In fact, the only people that can do it are these entrepreneurs. It's the entrepreneurs who are going to actually rent the capital. They are going to buy the capital from somebody. Could be capital producers, could be the households. I mean, it actually doesn't matter. It's a matter of interpretation. But the idea is that the provision of capital to the markets involves something, and it's like magic. Again, you think about capital as wires and glass and plastic. Some people who take wires, glass, and plastic and provide it into the market, it's gold, and some people do it and it's nothing. And so it's the entrepreneurs who are involved in that thing. The BGG idea makes a big deal out of that, out of this one thing that never actually, in my experience, ever was even discussed before. And then we get into the conflict of interest, because the entrepreneurs, they have their own resources. They're going to buy the glass and stuff, and then they're going to put it into the market. They do their own resources, plus they also borrow, and then there's asymmetric information about what actually happened with this glass and plastic. You know, the glass and plastic doesn't work, and then no one knows what happened, what didn't happen. You need to have bankruptcy costs, and it's just a cloud of, the entrepreneurs know what's going on, but no one else does. We can't have the standard sharing contract. So let me do the picture here, the helicopter picture. So again, we're going to start out with the households. Households are the source of labor. It goes to the labor market. Labor goes to the firms. Now, the capital is not coming from the households. The capital is coming from entrepreneurs. The capital is owned by entrepreneurs. And then at the end of the period, there's production. The consumption goes down to the households. Investment goes to some kind of capital producers. These are the people who make the capital. The entrepreneurs are going to sell all of their capital to the capital producers. But by the way, those capital producers could be the households themselves. It actually is a matter of notation, really. It doesn't there's nothing substantive here. The entrepreneurs sell the capital to the capital producers, and then after that, what happens is dinner time. It's quiet. Nothing happens for a second. And then people wake up. The households now lend money to the banks. The banks are now going to make loans to the entrepreneurs. The key thing to notice is that now the entrepreneurs have only cash because they sold the capital to the capital producers. So the entrepreneur's net worth is well defined. If you're serious about net worth, you'll realize that actually net worth in practice is not well defined. Like in my own case, I don't know what my net worth is, because a big part of my net worth is my house. And I haven't sold my house anytime recently, so I don't really know what my net worth is. And most firms, you don't really know there's a lot of uncertainty about what firms, when you lend to somebody, it's not clear what people's net worth is. In this environment here, we're making it very clear by having the entrepreneurs actually just sending the capital through a market, so we know exactly what they have. And then what they do is they go and get these standard debt contracts from the banks, and they use the proceeds to buy the capital that was made by the capital producers, and then in the next period, they rent that capital. So the job of the entrepreneurs, it's a weird thing. I mean, if you never went outside in your whole life, and all you did was you studied the standard economic model, you would not understand this at all, because this is always viewed as an invisible, not important thing, which is the placement of capital in the market. But these guys are making a big deal out of that. And another way of looking at this is that it's the picture that we had before. The households are giving money to the banks. The banks are going to be giving loans to the entrepreneurs. The loan that's going to be given is a standard debt contract, and the mean of those things is all equal to 1. I've now changed the notation a tiny little bit by being explicit about, remember, this is a log normal distribution, so log normal distribution has two parameters, the mean of the normal that's in the log distribution and the variance of the normal that's in the log distribution. But those parameters shrink to one parameter when I impose that the expected value is equal to 1. And that one parameter I'm going to call the sigma. And that sigma, I'm going to suppose, is moving around randomly over time. and moving, therefore, the contracts around and moving the whole economy around, and we're going to find that that accounts for nearly 50% of the fluctuations in GDP. By the way, one thing at a technical level, remember this is all linearization, so these are all first-order perturbations that we're doing. Remember, the result I showed you at the very beginning was that G sub sigma was equal to 0, that a change in a variance has no first-order impact on decision rules. Well, here we have a variance that's mattering, and it has a first-order impact, and so it seems to contradict the result that was described this morning. In fact, it does not, but it seems to. It's more a semantic problem. As the sigma moves around, the distribution, the cross-sectional distribution of productivity of the entrepreneurs changes, and that has a first-order impact on the parameters of the contract. So it actually, this sigma here has a first-order impact. We don't have to go to third-order, fourth-order things to get this guy to work. This guy here, this sigma here, which is a cross-sectional distribution, has a first-order impact on the equilibrium. One thing you have to start thinking about when you get into this world is you have to start distinguishing between a cross-sectional distribution and a cross-sectional variance and a time series variance. In fact, there's a great deal of interest in recent years in cross-sectional variances. Probably Nick Bloom, who we saw at lunch, he had his other group here at lunchtime, was maybe a first person to really look at this a lot. He looked at this in the Compustat data. He looked at the cross-sectional variance of sales growth and stuff like that and how that moved over the cycle. But now we have many more people who have looked at this kind of thing. Tao Jia has looked at this also in the Compustat data. I have a student, Matthias Kerrig, who looked in the census data, cross-sectional distribution of TFP shocks. So cross-sectional stuff, I think, is going to be an increasingly interesting thing for people to look at. And that's what that sigma is. It's a cross-sectional thing. But this cross-sectional thing has aggregate implications. When there's more spread, the entrepreneurs are going to borrow less and they're going to buy less capital. That's going to be a first-order effect, up to the tune of 50% of GDP. Now, while the microeconomic discussion that we just went through is kind of useful, it delivers almost all the equations you need, but it misses one, because in the micro discussion, there was only one period. So we don't have any notion of a law of motion of net worth over time. In a dynamic model, you have to add that. And so here you get an equation that looks like this. It's an equation that you could actually spend a lot of time talking about, but I'm not going to spend any time talking about it. This is the net worth of an individual entrepreneur. This is the net worth of the individual entrepreneur at the end of the period, and you can see what all the components are, and it's actually a lot of fun to look at them, but I'm going to have to restrict how much enjoyment I get out of this thing. So if you look on the net worth, the real net worth is on the left-hand side, and if you look at the sources, you can see there's two income sources. One is the value of their assets. So the A now is actually capital that they're buying. The value of that, PK, is the price of capital, and their net worth will fluctuate as the price of capital moves around. You get capital gains. Entrepreneurs are now experiencing capital gains and losses in this thing, because as the price of capital moves from the time they bought the capital to the time they sell it, they make a capital gain or a loss. They also have a regular flow income. They rent the capital into the market, so they get RK times K bar. Of course, they're the individual entrepreneurs. When they buy the capital, they then get their omega shock that either makes their capital bigger or smaller. You can think about omega times K as capital and efficiency units. Your wires in plastic are maybe much better than somebody else's wires in plastic because you draw a higher omega. That's what that's capturing. So you can see there's the two income effects. Well, there's the capital gain effect and then the income effect. And then you have the debt effect. These guys have to borrow in the previous period, and that shows up as a minus sign. And you can see the debt deflation effect in here too, because if they borrow at a fixed nominal interest rate Z at time t minus 1, and there's a jump in inflation, well, that means that the value of their debt has gone down, and there's a minus sign there, so that actually improves their net worth. So you have the so-called Fisher debt deflation effects that happen in this environment. An entrepreneur who borrows a lot of money has to pay it back in the next period. That enters as a negative sign. But if the value of money is declined from one period to the next, as happens when you have inflation, then that's a boost to their net worth. As I say, this is something that one could talk about a lot more, but I'm not going to do that. Not going to do that here now. Here are the simple adjustments that you have to make to a model. The first thing, if you take a standard model, it's very, very simple adjustment. After all this blabbing around, you might think it would be a lot of an adjustment. First thing you do is you take the equation for the intertemporal Euler equation for capital, the one that I showed you on the first slide, that's out of there. You delete that equation. And then what you do is you have to add the equations associated with the loan contract. So one equation you have is the zero profit conditions of the banks. That has to be satisfied. That's one equation. And then you have to add the efficiency condition associated with entrepreneurial choice. Remember that first order condition. That's an equation in terms of omega bar. Got to stick that thing in there. That's when you have to type in the CDF and things. You also have to type in the law of motion for entrepreneurial net worth. So the three equations associated with the contract, you have to type those three equations in. And you also have to put bankruptcy costs in the resource constraint. Although if you forget, that's fine too. Because bankruptcy, whatever you do, you better have those bankruptcy costs being small, because bankruptcy costs in the actual date, there are not many bankruptcies. They absorb a tiny fraction of GDP. And if your model is any good, it should be the case that if you forget to introduce the bankruptcy costs in the resource constraint, it won't make any difference. But to be mathematically correct, you have to put it in there. So these are the adjustments. And so let me now try to go and talk about the results. First, talk about some intuition, repeat intuition that was done earlier. So I'm going to argue that these risk shocks have a big effect. Let's just talk through it one more time, because it's very important to get the intuition, because I want to argue they're big shocks. And then, so this is the normal CDF. And remember, all the entrepreneurs in the economy are assumed to have the omegas are drawn, there's a small number with omegas way out here, la, la, la. And what the risk shock means is that there's an increased spread in that distribution. So it widens out. The one with the higher variance is this thing here, and you can see it has more density on the left. And now what you cannot see is that it has, well, you can sort of see if you have a microscope, that it has more density on the right. You can see it's trying to poke its little head up. See the little head of the guy there? It's trying to be above the blue line. So it has more density on the right, and of course if it has more density on the left and the right, it's got to have less density in the middle, and then what you can see there is that it has less. So this is a mean preserving spread in a log normal distribution. So I'm imagining now in the general equilibrium model that this is occurring. And what do we think is going to happen? Well, number one, the banks become sensitive to the fact that there's going to be more people in the left tail. The bank is not thinking about the people in the right tail because they walk away under a standard debt contract. So the bank's aware of that. The banks have to raise interest rates. The menu of contracts has to shift up. And the entrepreneurs respond to that in the equilibrium by borrowing less. And then when they borrow less, they buy less. Now we know what they're buying. They're buying physical capital. They're buying less physical capital. When they buy less physical capital, the people who make physical capital are going to buy fewer investment goods. And the people who when they buy fewer investment goods, there's going to be less output being purchased, so employment and output and stuff is going to drop. And so this is the loose intuition about how a risk shock would work. Increase in risk leads to a higher interest rate on entrepreneurs. They're going to borrow less, buy less, and they're going to lead to less buying of investment goods, and the economy tanks. There's a monetary policy equation in here that's completely standard. Nominal interest rate is a function of all this stuff. So what I imagine I did was I took a standard model, I did the modifications I just described, the list of 4 things, stick in this monetary policy rule, do some estimation. The fun thing about estimation is that you now can use not just the standard macro data, consumption, investment, la, 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 but also you now get to bring in financial variables. So I'm going to use interest rate spread, the difference between B, AA, and AAA corporate bond returns, be my measure of the spread. I'm going to have the value of the stock market, which I'm going to associate with the net worth of the entrepreneurs in the model. I'm going to include credit to non-financial business as a third variable. Actually, there's a fourth thing, which I forgot to write there, which we're all going to also look at the slope of the term structure, but I'm not going to say anything about that. This model actually works nicely on the slope of the term structure. And there's the data set that's used, 1985 to 2008, quarter 4. Do standard estimation results? I'm not going to tell you about it because we don't have time. Well, so the key result is risk shocks are important. And there's a reason to think that they deserve to be taken seriously. So let me talk about that. First thing I want to do is I want to document to you the sense in which they're important according to the model. The second thing I want to do is I want to tell you what the model, if you taught the model how to speak English and use normal non-jargon language, I want to tell you what the model would tell you in answer to the question, why are they important? What is the simple intuition? And the third question is, if all of a sudden we have a shock that drives 50% of GDP fluctuations, but previous people who were doing estimation, they found other shocks driving it, some shock has to be demoted. And I'll focus on one in particular, the marginal efficiency of investment. Okay, so here's an example of the sense in which the shock's important. In this diagram here, the solid line is the actual data. So this picture here is GDP growth, year over year, percent GDP growth in the US. And this here is the log level of equity, so that would be the Dow, real Dow divided by population. This is the interest rate spread, this is credit growth, and this is the slope of the term structure, which I thought I wasn't going to talk about, but evidently I am talking about it. So if what the dotted line is, you get the dotted line by taking the estimated risk shock in the data, so the sigmas that we estimate, and feed only that shock to the model. And then simulate the model response, and that's what the dotted line is. So the dotted line is an answer to the question, what if the only shocks in the data were the risk shocks? What would the history have looked like? And the answer is, history will look roughly the same, which is worrying a little bit, I suppose. But if you look over here, for example, this risk shock in terms of GDP growth is accounting for lots of the fluctuations. One thing that's interesting is it's missing on something. So notice that you get this dip in output here. This is 2007. This is where 2007 is where the end of 2007 is where the current recession starts. And notice that the little risk guy is saying, hey, everything's fine. Notice it's way up. The dotted line is way up high. Well, there's actually a simple explanation for that, which is the risk shock actually in the analysis is very closely related to interest rate spreads. The model, the econometric model, thinks that interest rate spreads and the risk shock are very similar variables. In 2007, the spreads had started to rise a little bit, but not a lot. They also rose a little bit in 2008, but not a lot until the end of 2008. So in some sense, the beginning of the recession seems like a different animal than what happens around the time of Lehman Brothers, later in 2008. And this analysis here is kind of consistent with that. This thing is just going along rosily, and apparently there's nothing special happening, and not surprising, the spreads weren't high. In fact, if this thing was signaling anything other than that, I would really be very skeptical about this. Partly because I'm going to defend this model to the death. So that, anyway, so that's that. Equity, fantastic. This is outrageous. I mean, the equity shock, the spread shock gets the risk shock gets the premium, equity premium, almost the interest rate premium, the BAA minus AAA bond rates, are almost exactly right. Credit growth is very, very close. And even the slope of the term structure, this is outrageous and would deserve much more discussion than I'm going to give it now. Most people think that a model of this type cannot possibly come close to explaining the term structure because a model of this type has what's called the expectations hypothesis into it. And so people think somehow the expectations hypothesis is false. Actually, this model suggests that the expectations hypothesis indeed is false, but it ain't bad. That is, if you test it econometrically, you will reject it, but it's going to say that the hypothesis goes a long way. And this is one of the symptoms of that proposition. Anyway, that's one indicator of the importance of the risk shock, the proposition that it's important. Here's another indicator, which is the actual variance decompositions associated with the shock. It gets 49% of output, 63% of credit movements, slope of the terms. It gets various things. You can see it's big time in the spread. The econometric sort of thinks that the spread is the same as the risk shock. Now, next question, what's the why? What was the reason that why is it that the econometrics is deciding? So it's a very simple reasoning, I think. Number one, the econometrics thinks it's decided on its own that the risk shock is kind of the same. It's almost like 98% of the interest rate spread is the risk shock, is what it's saying. So that's one thing. The econometrics kind of noticed that. The second thing is that what's well known, I won't document that for you, the risk spread is strongly negatively correlated with GDP. That's a well-known thing, goes back to as long as we have data, that in booms, the risk spread is low. The BAA versus AAA bond rates are very low. And in recessions, that spread is very high. So you're starting to see here why the econometrics starts putting things together. I think the risk shock is the spread. I know that the spread is countercyclical. Must be that the risk shock is important. Actually, we need one more step, the crucial step. The crucial step is that the model sees and understands, and I'll show you that in a second, that in the model, the risk shock generates something that looks exactly like a recession. It generates a dynamic response that looks exactly like an actual recession. So you put A, B, and C together, done. In fact, I'm surprised the model doesn't conclude that 90% of GDP fluctuations are coming from this risk shock, based on this argument here. So the one thing that I need to document for you is this C here. The A, I've already documented. It thinks, I showed you that in the variance decomposition. The B is, I'll just tell you that's a standard result. And C needs to be shown. So here is, so this is the response of the economy to an unexpected movement in risk. The risk goes up. It's an AR1, you can't see it, but it looks just like the interest rate spread. It goes up and then it comes down. Okay, that's the impulse here. And then you can see what's happening in the economy. So if we look at credit, credit declines right away. We would have anticipated that from the micro, that the credit goes down. The risk shock goes up. The interest rate spread responds by going up in the model. Credit goes down. Investment goes down. Investment goes down. Output goes down. Net worth goes down. Why does net worth go down? Well, partly because GDP is going down, so the earnings of entrepreneurs are declining, and so their income is going down. Plus, they're making capital losses. Because there's less capital being bought, the price of capital goes down, they're making capital losses, so the net worth goes down. The stock market, that's the stock market. Oh, sorry, I probably scared some. So that's the stock market. The stock market's going down. Inflation goes down because the economy is going down, marginal costs are going down. Another thing that goes down in consumption, that's a little bit of a weirdo thing. In fact, some there are lots of economists out there, even though in our day and age you think everybody's supposed to play the rules and simulate. No, there are a lot of people who just sit around in chairs chatting. So there's a bunch of people out there who say that obviously a risk shock can't be a serious business cycle shock because it's going to make consumption go up. Why is it going to make consumption go up? Well, because a risk shock makes that intertemporal technology less attractive. Sending money intertemporally, saving, and involves more monitoring costs and all kinds of stuff. So the economy will naturally substitute away from that towards the alternatives, which include leisure and consumption goods. So there are profound economic thinkers who think that consumption ought to rise in response to such a shock, but it declines in this model. By the way, the reason that it declines is kind of fun, which I'll briefly mention. this reasoning that I just described about how the risk shock screws up intertemporal margin and then they substitute away into consumption and leisure, that comes straight out of a real business cycle model. If you put this into a real business cycle model, the risk shock would make consumption go up, make investment go down. And of course, then it can't possibly be a good business, an important shock, because in the data, consumption and investment move together. So if you have a shock that does this, no good. You got to have a shock that goes like that. Now, in the real business cycle model, when the intertemporal margin gets screwed up, you can think of high risk as high tax on saving. That's actually, you could formally, I have a paper where I formally show the mathematical isomorphism between this model and a real business cycle model, and a tax on saving. So you can think about high risk as like a tax on the intertemporal margin. And so the way the real business cycle model works is that when there's this reduction in demand coming from a decline in investment, the price of current goods goes down versus the price of future goods. By the way, what is that, the price of current goods versus the price of future goods? That's called the real interest rate. The real interest rate drops in a real business cycle model enough so that consumption rises and goes above what it is here. In this model, it's not. Consumption's falling. Anybody got an answer to that question? Why? Why is it that consumption is falling and not rising? Think about the Diner exercises we did. Diner, Taylor, weakness, weak, weakness. Huh? It's the damn Taylor rule. The Taylor rule is operating here, and the reason why consumption doesn't behave as it does in the real business cycle model, as it does actually under the efficient allocations, is because monetary policy is governed by the Taylor rule, and the Taylor rule is weak. And it doesn't cut the interest rate enough, and that's why consumption falls. So the whole picture here, anyway, so consumption's falling, and so on. By the way, there's another shock in here, the marginal efficiency of investment. So we could ask, what does that do? That used to be, the marginal efficiency of investment shock is viewed as, before this anyway, is viewed as the most important shock driving the economy by far. And notice that if you don't look at credit, if you don't look at any financial variables, credit, interest rate spread, net worth, then in fact the model, actually the two models look very similar. It screws up a little bit on consumption, but who cares? The key thing to notice there is notice that the marginal efficiency of investment shock, when it makes output go up, it makes the value of the stock market go up, which is completely contradictory. And let me talk about that for just a second. So the thing is that in this environment, when you bring in the financial variables, net worth, credit, and the interest rate spread, the econometrics does not like the marginal efficiency of investment shock, and it much prefers the blue line, which is the risk shock. And let me just explain panel E there for you. So a way to think about this, and this will also give you an insight into why it matters where you put financial friction. So one way to think about, to get the intuition here, is to think about the market for capital in this model. On the horizontal axis, I got the quantity of capital. On the vertical axis, I got the price of capital. There's a downward sloping curve, that's the demand. There's an upward sloping curve, that's the supply of capital. That's the people who buy investment goods and they operate the capital accumulation equation. They're the suppliers of capital. The marginal efficiency of investment shock is on the supply side of capital, affects the marginal cost of producing. And this gamma, the risk shock here, is on the demand side because it affects the ability of entrepreneurs to borrow, and so it moves the demand curve around. The vertical axis, the price of capital, is a key input into the net worth of entrepreneurs. In fact, it's probably the major input because that moves around so much in the data and in the model. So if you get confused and you think about that as just the stock market, that's just fine. This is not a Tobin's Q theory of the stock market, but that's okay. So now imagine you take the marginal efficiency of investment shock and move it around. It's going to move the supply curve around. Suppose you move it so that the supply curve shifts to the right. What happens to the quantity of capital traded? So marginal efficiency moves the supply curve to the right, makes it easier to produce. What happens to quantity of K? Up. Quantity of K goes up means investment has to go up. It means that output's going to go up. So we're going to get pro-cyclical investment out of this thing. What happens to the price of capital? Down. This thing predicts that the stock market is going to collapse when you get an increase in output due to the marginal efficiency of investment. Now let's go to the other side. Let's think about shocks to the risk. So you have risk moving around. Suppose that the risk shifts the demand to the right. You're going to get a boom, you get more investment, you get more output. So in terms of output, in sort of the terms of the standard macroeconomic variables, these shocks are going to be hard to tell apart. But when that risk improves and you get a boom, you also get a rise in the price of capital and you get pro-cyclical stock market out of this thing. This is just intuition for the impulse response I showed you. So the thing is, the marginal efficiency of investment shock looks great if you're doing an analysis that does not include financial market variables. If you look at the surge of investment and output in the 1990s, you're going to say, whoa, looks like a marginal efficiency of investment shock. But that's only true as long as you keep your blinders on. If you remove your blinders and you notice, for example, there was a stock market boom at this time, then the marginal efficiency of investment shock is a disaster for you. And that's what happens in this analysis. Okay, so what I'm going to do now is I want to stop here with these two slides here. So the big message here is that this risk shock is important, and I think it's important for very intuitive reasons. If you describe this to a normal person, they'll say, I don't need any more analysis. I totally buy your risk shock as being important. Still, it's useful to know, is the model good enough to actually believe it? And the model fits the data well in the sense that it does well at predicting things that were not used to construct it. So for example, it does well at out-of-sample forecasting, which is an important test for a model. It also predicts well variables that were not used in the estimation. We did not use bankruptcy rates, but we can use the model to calculate what it thinks the bankruptcy rate was, and it's fairly well correlated with actual bankruptcy rates. Similarly, Bloom went out and did these cross-sectional variance things that I mentioned earlier, and his estimates looked similar to our risk estimates. So in that sense, the model seems to fit well in the sense that it's consistent with stuff that was not used to construct the model in the first place. Okay, conclusion. Much of the dynamics of this past data you can explain as reflecting something that looks like a risk shock. This shock is taken as an exogenous variable in this analysis. If you take serious this analysis, I think the next thing to do is to start thinking about what endogenous mechanisms is that exogenous risk shock a stand-in for. I don't know if you don't have the perspective that I have with time. I can tell you that in the real business cycle analysis, that all started out with treating a technology shock as an exogenous shock. That's the way real business cycle analysis worked. And it was a damned good shock. And every time something bad happened in the world, it's amazing, the technology shock always went down. You even go to the East Asia crisis, 1998, and you see a collapse in output, measure technology, down. Every time something is bad, TFP is down. And so what has happened with the discovery of the importance of this thing, which was initially called a shock, there's a lot of research done to figure out what are the endogenous determinants of TFP. So people talk particularly about financial frictions, about the misallocation of resources as explaining TFP movements. And I think a similar thing happens here. You want to think of a shock as a box. It's a box, and you have lots of shocks, and you fit the data in all these boxes, and the box that turns out to be the biggest, the one that can carry the most data, that's the one when you want to put your resources and think about. So I interpret these results here as suggesting that it's useful to think more about these shocks that look like what we're calling here risk shocks.